Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Tesla's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Tesla is an electric vehicle and clean energy company. It designs and manufactures electric cars, battery energy storage, solar panels, and solar roof tiles. The company had the most sales of battery electric vehicles and plug-in electric vehicles, capturing 16% of the plug-in market, which includes plug-in hybrids, and 23% of the battery electric market. The battery electric market are purely electric vehicles. Through its subsidiary, Tesla Energy, the company develops and is a major installer of photovoltaic systems. Tesla Energy is also one of the largest global suppliers of battery energy systems, with 3 gigawatt-hours installed in 2020. The company is headquartered in Palo Alto, California, and was founded in 2003. It trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Xetra, Vienna, Swiss, Kazakhstan, Sao Paulo, Italian Bourse, Lima, Buenos Aires, Bulgaria, Ukraine, and London Stock Exchange. Let's get started with the model. This is a large cap company, slightly over 1 trillion market cap, $1,056 a share, and they have 1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow for a long time because they were investing so much back into their business. But now they have pretty healthy free cash flows. It was $2.5 billion in the trailing 12 months, $2.7 billion in 2020, and it was nearly $1 billion in 2019. So the company has done a good job growing and becoming profitable. Net income is the profit or loss on the income statement. It's revenue minus expenses. That peaked in the trailing 12 months at $3.6 billion. Revenue is the sales for the company, and that more than doubled since 2018 from 21 billion to 47 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that broke through 10 billion in trailing 12 months. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that more than doubled from 2020 to the trailing 12 months at $4.5 billion. Below that is the interest they pay in their debt, and that's a little over $500 million. Then below that is other income and expenses. These are all of the gains or losses not tied to the core operations of the business. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which was their best ever by far in the trailing 12 months at $3.6 billion. It was negative every year before 2020. This is their income statement from their quarterly report. This shows us the first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. The top is the revenue. That was $14 billion in the third quarter of 2021 versus $9 billion in the third quarter of 2020. A bulk of their revenue is from automotive sales, $11.7 billion, less than $400 million from auto leasing. Automotive revenue was a little over $12 billion. In the same quarter last year was $7.6 billion. Here's a breakdown by quarter of their car production and deliveries. The deliveries for Model S and Model X peaked in the fourth quarter of 2020 at 19,000. Now it's 9,000. Those cars cost about $100,000 each, but the Model 3 and the Model Y are much more economical, about half that price. And that's been going up every single quarter, peaking in the third quarter of 2021 at 232,000. Tesla's market share in the US and Canada is below 2%, so they have plenty of room to grow. And it's just over 1% outside of US and Canada. Energy generation and storage went from 600 million to 800 million. The company mentions in their quarterly report the long-term success of energy generation and storage is dependent upon increasing margins through greater volumes. For Megapack, Energy storage deployments can vary a lot depending on timing of specific projects. Megapack are large-scale battery storage systems where people can store energy for future use. Regarding their Powerwall, there seems to be higher interest, and they're also emphasizing cross-selling with their residential solar projects. Powerwall is a rechargeable home battery system that stores energy from solar or from the grid and makes it available on demand. So if there was a blackout in your community, if you had Powerwall, you would not be affected because you can just pull from this battery storage. Powerwall is for individuals like me and you. Megapack is for a larger entity. For example, Megapack can power 7,000 homes in one day. They also sell and install solar panels on people's homes, and they also provide financing as well. Services and other went from 600 million to 900 million. This includes vehicle services after the warranties expired. Also the sale of used vehicles, also retail merchandise like Tesla hats and shirts, and also they sell vehicle insurance. Here's a breakdown of their revenue by location. Less than half their revenue is in the US, about 20% in China, and they do revenue all around the world. 4.2 billion is outside of the US and China. In order to generate the 12 billion of automotive revenues, it cost them 8.4 billion. In order to generate the 806 million of energy generation and storage, it cost them 803 million. So they're not really making much money there. Same thing with services and other. In order to generate 894 million, it cost them 910 million. So they're actually losing money. They spent 600 million in R&D, 994 million in SG&A. They spent 126 million of interest on their debt. In the third quarter of 2020, it was 163 million. So they did have net income of 1.7 billion, which is more than 4 times higher than the third quarter of 2020. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. I really wish I focused on their operating cash flow when people were telling me about Tesla for the past few years, because I made the mistake of always looking at their net income and seeing losses. But even in 2018, they had negative free cash flow because they invested 2.3 billion back into their business through CapEx. If you're investing in a company with negative operating cash flow, that could be a problem, because at some point you have to make money on your day-to-day operations. But if you invest in a company with negative free cash flow because they're putting so much back into their business, that's not necessarily a bad thing. That could lead to greater growth in the future. And you could see their operating cash flow went up almost 5 times, from 2 billion to 10 billion. That's lots of cash flow to work with. And they're putting a lot back into their business, over 7 billion in CapEx in the trailing 12 months. That's exactly how this company does it. Similar to Amazon, throwing so much back into the business to grow it, building more factories, investing in their technology, getting the best employees. And that's why the stock has gone up so dramatically. But they're starting to bring in positive free cash flow now. It was over $2.5 billion, even with investing over 7 billion back into the business. Now that they're bringing in positive free cash flow, they are paying down debt. They issued 9.7 billion, repaid 12.2 billion, so they decreased their debt load over 2 billion in 2020. They decreased it over 6 billion in the trailing 12 months. They are adding a lot of stock. They added 12 billion in 2020 and 5 billion in the trailing 12 months. That's not so bad because the stock price is so inflated that they're getting a good deal. Because if it does go down a lot, then they could buy back stock at the lower price. But if the stock price doesn't go down, it's still fine as long as they bring in positive free cash flow. This is their operating cash flows from their 10Q. The first 9 months of 2020, the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with 3.3 billion of net income, we add back depreciation and amortization, we add back stock-based compensation, those are non-cash items. Then we have to adjust for changes in working capital. They spent over 1 billion of inventory, that's a cash outflow. They spent over $1.5 billion on operating leases. That's a cash outflow. They seem to be purchasing a lot of products on credit. That's a cash inflow of $2.7 billion. When you take on accounts payable, it's like taking a loan, but you're not receiving cash, you're receiving a product or service. In the accounting period they do pay back the accounts payable, it will detract from their operating cash flow. They reported an accounting profit of $3.3 billion, but actually brought in nearly $7 billion of cash flow. Last year it was an accounting profit of $500 million, and they brought in nearly $3 billion of cash flow. This is the investing and financing section from their 10Q, the first 9 months of 2020, the first 9 months of 2021. The first line of the investing section are purchases of property and equipment. That was almost $5 billion in 2021. Last year was $2 billion. They purchased $1.5 billion of Bitcoin in the first 9 months of 2021. They sold $272 million of Bitcoin in the first 9 months of 2021. So in their investing section, they had a cash outflow of $6 billion. Last year was a cash outflow of $2 billion. In their financing section, they raised $7.6 billion from issuing convertible debt. They bought back $11.5 billion of convertible debt. They received $445 million from the sale of stock options. They paid down $300 million on the principal part of their finance leases. The interest part of their finance leases is in the operating cash flow section. In their financing section, they had a cash outflow of $4 billion. Last year was a cash inflow of $7 billion. Let's look at the equity section on their 9/30 balance sheet. They have $27 billion of equity. They raised $29 billion from selling their business, and they lost $2 billion from running their business. But I'm pretty confident their accumulated deficit will become an accumulated profit sometime in 2022. Let's look at their capital structure. They have $27 billion of equity, $10 billion of debt. They're 73% equity, 27% debt. And they could pay off all the debt with the cash on their balance sheet and still have $6 billion of cash left over. And I gave them the lowest whack on Finbox, 7%, and that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7, that's $680 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $480 billion. We divide that by 1 billion shares. And we get a calculated stock price of $480. They're trading at $10.50, so they're trading at a 119% premium. It's a sell according to the model. Their annual revenue is expected to increase 22%, so I increased their revenue 22% for the next 7 years. That's how I got their future revenue estimates. To get their future free cash flows, I need to estimate what percent of their revenue they'll convert to free cash flow. Their best year was 2020. They converted 8.5% of their revenue into free cash flow. So I rounded that up to 9%. It's almost unheard of for a car manufacturer to convert more than 10% of their revenue to free cash flow. Unless you're a really high-end manufacturer like Lamborghini. All the big companies like GM, Ford, they convert between 5 and 10% of their revenue to free cash flow. But I doubled the 9% to 18%. I assumed they would convert 18% of their revenue in 2027 to free cash flow. Even though I think it would be really, really difficult for them to do that. But even so, they're still coming out with a stock price a lot lower than they're trading at. This stock is definitely an anomaly. There's almost no scenario where I can value this company at a 1 trillion market cap. But you need to understand the value of anything is what people are willing to pay, not what it's worth. It may be worth well over $1 trillion one day, but as of now, I don't think it's even close. Simply Wall Street's valuation is $485. They're also saying the stock is really overvalued. 25 analysts priced this stock and the average price target was $10.25. The low was $215, the high is $1,600. Pricing a stock is different from valuing a stock. When you price something, you're saying how much you think people are going to pay for it. When you value something, you're saying how much something is worth. Tesla is doing a great job at growing their car sales. It pretty much grows overall. There were some quarters they had less sales than the previous quarters, but overall their sales have gone up. They're close to 1/4 million cars sold in the third quarter of 2021. The trailing 12-month number is a lot smoother. So you can see the trailing 12 months as of 9/30, 2021 was over 800,000 cars. When you invest in a car manufacturer, you need to see how many cars they're selling. It doesn't matter how great their technology is. It doesn't matter what analysts are saying. The most important thing is the number of cars they're selling. And they are selling cars, and it's going up each year. Granted, it's not a lot of cars relative to Ford and GM. This is where the stock has been trading the last 2 years, so it's pretty much only gone up. It went up about 10x from 2 years ago. It looks like 1200 is a resistance point, but I wouldn't be shocked if the stock hit 2000 sometime in 2022. Nobody thought they could hit 500 billion market cap. When they did, everybody said it's impossible for them to hit 1 trillion. Now they're at 1 trillion. They have a pretty high beta, 2.04, so the stock moves more than 2 times the market. It's very volatile. It's gone up 47% in the past 52 weeks, while the S&P is up 29%. The 52-week low was 540, the high is 1240, and the stock is trading above its 50-day and 200-day moving average. The stock price is really high. I'm talking about the nominal value. Over $1,000 a share is a pretty high stock price. But they still have over 25 million shares traded each day in the past 3 months. That's a lot of activity. Of the 1 billion shares outstanding, 800 million are on float, 42% are held by institutions, and a little over 3% of the shares are shorted. They add employees every single year. Their employee count is going up as fast as their stock price. They employ 71,000 people. If you put $10,000 into this company 10 years ago, you'd have almost $2 million today. That's a 20,000% return, 69% annual return. Elon Musk sold over 5 million shares back in November. His brother sold about 100,000 shares. Institutions own 45% of the company, 36% by the general public, and 19% by insiders. Elon Musk owns 18% of the company, 177 million shares valued at $187 billion. The next biggest is Vanguard, then BlackRock, Capital Research, and State Street. Let's look at their financial ratios. Their PE is really high at close to 300. That means investors are paying $300 for $1 of earnings. PE is stock price over earnings per share. Price to sales is also really high at 23, and price to book is also poor at 39. They have 4.2 billion of operating leases, 5.8 billion of solar energy systems, 17 billion of PP&E, 2 billion of operating leases, 1.3 billion of Bitcoin, and about $500 million of intangibles. They have a really good return on invested capital of 17%. They can cover their interest payments with their operating income more than 8 times. They have a good ROE at 13%, much better than the market median and average. Their current ratio and quick ratio are both above 1. Let's look at their current assets as of 9/30. 16 billion of cash, 2 billion of accounts receivables. This is how much other companies owe Tesla. 5.2 billion of inventory and 1.7 billion of prepaid expenses. Let's look at their current liabilities. 8 billion of accounts payable. That's how much Tesla owes other companies. 5.4 billion of accrued liabilities, 1.8 billion of deferred revenue. When someone pays for a product or service before it's delivered, then Tesla books that revenue into their liability section as deferred revenue. Once they deliver the product to the customer, then they pull it out of deferred revenue and put it onto the income statement as revenue. 800 million of customer deposits at 1.7 billion of debt. They generated 2.5 billion of free cash flow in the trailing 12 months, and they have nearly 7 billion of working capital. Working capital is current assets minus current liabilities. So they're really well funded. They have $9.5 billion of funding. The best way to look at ratios to compare them to companies in the same industry. There are 28 companies in the same industry as Tesla, and Tesla is the largest company by far. They're actually larger than the other 27 companies combined. They're pretty low in debt, so their debt to equity ratio is better than the average. You can see how leveraged Ford is. They generate more free cash flow than the average company. Their market cap is on another planet. Their price to book, price to earnings, and price to cash flow are a lot worse than average because investors are looking towards the future and they see major growth with this company. Their price to sales is better than average. Their revenue is higher than the average, but their revenue is a lot smaller than a bunch of companies in this industry. Their 5-year revenue annual growth rate is amazing at 51%, much better than average. A return of assets over 5% is considered good. They're at 6%. Return on assets is net income over total assets. It shows us how profitable a company is in relation to its assets. Return on equity is net income over equity. 15 to 20% is considered good. They're at 13%, which is not bad. You should always compare ratios to others in the industry, not to the entire market. So to summarize, I have them trading at a 119% premium, and we're all kicking ourselves for not investing in this company sooner. A lot of people now think it's too late, but we've been saying that for a long time about this company. It's too late to invest in them. Maybe now it is too late. I'm not sure, but it seems like the stock price keeps going up. They are number one in electric vehicles, and I don't see any company taking that away from them. I rank their free cash flow 7 out of 10, their revenue 9 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.